All right, good afternoon, everyone. I see several people coming in, so we're going to wait for a minute or so, making sure that everybody that was in the waiting room can make it in. Right, I think we can start now. So good afternoon, everyone, and Happy New Year to all of you. This is our first economic update of 2025. We have a new year. We have a new administration. We still have inflation pressures. We still have a lot of questions that we receive from you guys on a regular basis, but hopefully here we will be able to answer many of them today. We're very glad that our friends from Russell Investments have accepted again to come back and talk to you to give you an update. Mark Eibel has been with us now for almost a year and a half, doing these webinars every 6 months, and they have been very, very popular. So, Mark, welcome back, and thank you for allowing us to have you.
It's an honor
here.
to be invited back, so I'll take that as a win. Thank you.
Perfect. Yeah. So we're very happy, and the clients love it. So thank you for being back here. So we have a lot to cover. I'm just going to go ahead and turn it back to you and start with your presentation. So Mark.
Great. All right. Thank you very much. I will. Our recent economic and market update is out. I'm going to cover 6 or 7 slides from it. There's 26, so count your blessings. I will hit on the ones that I think get at either the topics I know have come in or just the ones that I've been using on calls that I think hit on both where we were from last year and maybe stuff that we're thinking about for this year. It's been an interesting period between the election and now. I kind of feel like we're all lame ducks. We're lame duck investors, right? There's lots of stuff being talked about. Tariffs, immigration, tax policy, deregulation. The market moves on every kind of rumor or thought that comes out, and yet there's nothing that can actually be implemented until the new administration takes over. So whether or not you are happy, sad, or indifferent to the election results, at least we're going to know starting next week, okay, now what policies actually roll out. So, and we'll talk through some of those issues as we go along. But it's been an interesting last couple months. We had a run-up right before the election, and then a typical run-up that we normally get after elections, no really matter what the results, and just kind of trickled that away throughout the rest of December. Kind of slightly up so far year to date. Boy, the markets yesterday sure helped us out with that. So we've just kind of been bouncing around since the election, but now we're going to actually see what happens. So let's start with the first slide. This is a typical slide that we use at the end of the calendar year. And I've been doing this for 40 years, and every few years, the 60-40 diversified portfolio kind of gets beat up in the media. And I always kind of wonder, well, what's the real alternative, right? Most people can't take, and it doesn't have to be exactly 60-40. It's just a diversified portfolio. Most people can't take above 80% in equities because, boy, those down days, they might not be as many of them as up days, but that's hard to live through. Many people can't be too conservative because the issue that we're all dealing with, which is a good issue to deal with, is longevity, right? And so in order to kind of have enough money to retire on, but have it be within a risk level that you can tolerate, as long as you're getting good advice, which you are, kind of ends up with most people somewhere in this range. So we put 60-40 up here. We split the equity to be 2/3 U.S., 1/3 non-U.S., and I'll explain in a few slides on why we think that's a good starting point. Well, this is what you get over the last 40 plus years, right? And so visually, I love slides where you probably already know the answer because you can see it, right? I don't have to explain it. Look how many periods are above 0 versus below 0. Now, it's in those periods, particularly like 2008 or 2022, where the diversified portfolio is broken kind of talk comes out. What I find interesting is nobody ever talks about what happens in the year after. Look at 2009 and look at 2023. You'll find them pretty far to the right on years that were really good. Nobody talks about it in the media then. They just talk about it when they think it doesn't. So if you look at the amount of observations that have really been kind of significant negative experiences, we're down to 2. 5 others that were negative, a lot that were positive, and a lot that were really positive. So I think it works. Last year's a great example, though, of you can kind of be wrong and still be right. If you had asked me, and you probably did going into last year, I would have said, I think we're setting up for a pretty good market in fixed income or bonds. Equities are kind of expensive, so maybe they'll have a tougher time in 2024. And of course, what happened? Well, bonds didn't do much if you take into account the whole period, and equities, particularly in the United States, is just up 20% plus. So the good thing about this portfolio is you own them both. So I'm going to say the same thing heading into this year that I said last year. Maybe I'll just keep saying it until I'm right and hope you don't remember how many years I said it. Bonds look pretty good here because of interest rates, and we'll get to that in a slide in a minute. Equities in the U.S., if they were more expensive before, they got even more expensive, and yet there are pockets of the U.S. That are fine, and the rest of the world is really cheap. We'll hit in on all these topics as we move forward, but I think this is a good start slide to just kind of level set and say it was a good year. I'm sure these numbers hit whatever planning assumptions that you might have. Now let's kind of carve it up a little bit more detail. So let's go on to slide number 2. This is an interesting way to look. So the top slide is just the last 40, I think it's 41 years, 84 to 2024. Just, what did the US market do? The bottom half of the chart is one I want to focus in on. So there's 41 periods there. And this kind of gets at the question that a lot of people present me, which is, Mark, US market, it's done well. Why do I want to invest in a market that's done so well? I feel like I'm buying expensive, right? And I understand that sympathy, and I'm sympathetic to that, and I understand that argument. Couple things. Number one, I hear that a lot when markets are up. Quite frankly, I hear that a lot when markets are down. People go, well, I don't want to invest in this market because I'm worried, or whatever's caused this market to go down, I think it's going to last longer, it's going to be deeper, it's going to be worse. I'll just wait, and I'll know the time to get back in. So as human beings, we get into this behavioral trap of you don't want to invest in the market when it's up, and you don't want to invest when it's down, right? You got it. That's where we get. So this kind of helps you maybe with that. Boy, what are the returns after different buckets? So what you see on the bottom is, first of all, and just positive. 34 of these times, market was positive. And on average, what did the market do the year after you had a positive year? Pretty good return, right? 12.5. And then it's just the different return buckets. So we zero in on the 20 to 30% bucket because that's what we did last year. Well, we've done that 9 times in the last 41 years. And the return, yeah, it's lower than the rest of them. But, you give me 7.9% this year, I'll take that, right? I mean, that fits right into my own planning assumptions. What surprises me is look at the years above 30%. We've had 6 of them. The market does great the year after that, which doesn't seem to make sense, but that's what the data tells us. And then there's been 7 negative periods. Market does just fine the year after on average. So my point is whether markets are up or whether markets are down, seems to be just stay in the game, right? I mean, that's always one of my overarching messages for people. Longevity is what you're managing for, right? You're not managing for the next election. You're not managing for the next earnings season. You're not managing for the next Fed meeting. You're managing for, I want to have enough money and I'm living longer. And that's a challenge. Well, how do you do that? You got to stay in the game, and you got to have good advice and a plan and manage your taxes and all that. So I just want to maybe give some comfort to people. Now, I don't know what this year is going to bring, but your time horizon, I'm assuming, is long enough that you'll look back and go, well, I'm glad I just stayed in, or I had kept my systematic contributions going in and didn't get too caught up in, is the market up or market down? And that's kind of what this slide is supposed to help you with. The last slide will kind of help you with that too. All right, so let's dig into equities a little bit, and then we'll talk about bonds a little bit. This kind of gets into US and non-US and all that kind of fun stuff. So what you see here, and I'm going to zero in on the right-hand side of the chart, this is just a pie chart of kind of the world's market cap, right? It's kind of unbelievable. If you look at those, and this is only carving out 4 of the names kind of in the Mag 7, but if you take those 4 names on top and the rest of the US at 51%, I mean, you're looking at 66, 67% of the world's markets at this point is just the US. So earlier when I said we think 2/3 US, 1/3 non-US makes sense, well, here's why. because that's almost the strategic default position of just being neutral to the world at this point. And again, I think a decent starting point. And then you see the rest of the world slices, and what they get too small, so then there's just and the rest. What's remarkable about the US, and I probably brought this up in past calls, is keep in mind, we're 4% of the world's population at this point. Okay, 4. And we're a little bit less than 20% of the world's economy. Yet we're 2/3 of the market. That just shows you kind of this dominance that we've had for the last 10 years in US markets, largely driven by the technology names, this new technology, et cetera. We've seen this happen before when it wasn't the US. The decade before, all about emerging markets. They were the leader. Earlier on in my career, you had to have it all in Japan. So I hear these things throughout my career, put all your money here, put all your money here. And right now it's put all your money in the US. Now, I love my country. I think we're the greatest economy in the world, but I don't want to have all my money in one spot, because I've lived through periods where the US didn't outperform, and it's hard if all my money is there. So we think having 2/3 of it here, even though we're more expensive, if I carve out the 7 kind of technology names, we're not quite as expensive. We're not cheap, but it's a little bit more reasonable. So just by owning other stuff other than the 7 in the US, I think you're okay. And the rest of the world, and as you can see by a common measure, price to earnings ratio, I mean, the rest of the world is really cheap. But I think you can have some fun with this chart too. I mean, let's take Apple, right? Apple is 5% of the world at this point, market cap. And if you look down below, it's the same market cap as Japan. Japan is the 3rd largest economy in the world. The day Apple reports earnings, it's as if every company in Japan reporting on the same day. It's just kind of unbelievable if you think about it. Look at NVIDIA. NVIDIA is 4% of the world now, the market cap. It's the same as France and India, as entire economies, and all their publicly traded companies reporting on the same day. It just kind of tells you the size and scope of these companies. And again, great companies. We own them. We're just underweight them at this point because they're just, they're really expensive and the expectations are very high. So this maybe helps you kind of understand the 2/3, 1/3. The rest of the world stocks are cheaper. Now, the rest of the world tends to trade at a discount to the US anyways. Why? Because the US has been the lead economy for 150 years, right? I mean, we're the most innovative economy in the world. We've kind of earned it. So we get traded a premium. But normally we trade at maybe a 20% premium. Right now, the rest of the world is trading at a 40% discount to the US. So they're really cheap. And there are good companies everywhere. We saw an example today. The luxury good provider, I think is Richemont, in France, put up a great earnings number in our portfolios. We don't own all of France, but we like that name. And so we want to have exposure to those names in the portfolio. We also know that we get a bigger dividend when we own those names. The non-US companies tend to pay a bigger dividend than US companies. They don't do as much share buybacks as we do here. They just give money back to people directly. So I can get a bigger dividend and a cheaper stock on world-renowned companies by just owning something outside the US. And the last part of it for you to consider is the US dollar is strong right now. It has been strong for a while. And it's gotten even stronger in the last couple of months with this American exceptionalism kind of viewpoint that's come through from the election. So it's an expensive currency is getting even more expensive. Well, currencies are like anything else. Try to buy them low, try to sell them high. At some point, particularly if our deficits continue to grow, you're going to see the US dollar move down. Non-US securities tend to do better in that environment because they get translated back into US dollars for you as a consumer. And if the currency is weaker, it's just like anything else. If something's cheaper in your life, you can buy more of it or get more of it. So it's a currency hedge. It's a dividend play. It's a valuation hedge. And it's just a sleep at night. I don't want 100% of my money in any one part of the world, even if it's the part of the world that I live in. And hopefully just kind of seeing this in a pie chart form and just thinking through some of these other things, you kind of understand why we're 2/3, 1/3. We'll turn that dial up and down a little bit, but that's always our starting point on the equity side. Okay. Let's talk a little bit about the bond side. So we're going to move forward to, I think it's slide 17 in the deck. So fixed income, again, as an asset class, yes, not great returns last year. Had a great first kind of 6 months, which we thought it would, because in the environment where fixed income does the best is when interest rates are dropping, the value of your bonds moves up. And we saw that earlier last year when the Fed announced, here's the play. We're going to start lowering rates. They did start lowering rates. And if you looked at your bond returns through, say, June of last year, I mean, the 1-year return on a typical diversified bond portfolio was double digits. I mean, that's kind of what we thought would happen. Well, then you kind of gave it back in the second half. Why? Because particularly as we got through the election period, once the election was over, the tariff talks started, right? Tariff, immigration, some of these things that might be inflationary, and we'll talk about them in a little bit more detail in a minute. But as soon as you talk about inflationary, that makes interest rates move up, the value of your bonds moves down. And that's what you saw. In fact, the 10-year US Treasury bond went from 3.6% up to where it's at today, around 4.6%. That is a pretty big move. And nothing has happened other than discussions about tariffs or people assuming they're going to be implemented the full way they were campaigned on. And I always think of, there's political season where you've got a 2 bullet point soundbite if you're a politician, and you repeat that at every rally, day in, day out, no matter where you're at. Okay, that's politics season. Now we're into policy season, which is, well, we're going to do this. And what happens? Trudeau from Canada was at Mar-a-Lago 20 minutes later saying, wait a minute, if you do that, this is what we might do. China's already said, well, if you do that, this is what we'll do. Now we're into the policy framework, right? Of if you do this, I do that, which means you do this and I do that. And it usually ends up in a compromise. But the market has been pricing in long bonds, just kind of assuming, well, he said he would do this on tariffs. He's going to do it. He said he's going to do this on immigration. He's going to do it. And it's moved that yield up. So I think those yields are going to start moving down a little bit as we see what the actual policy is. Inflation numbers haven't really moved it too much as of late. We got 2 important inflation numbers this week, CPI being the one everybody talks about. Both of them came in a little bit lower than expectations, and the run rate on both of them is right around 2.5%, which is where the Fed wants to get to. Now, they haven't done that for a year, but they've done it for 3 months, and we still think the trend is that the year-over-year inflation numbers will drop, because I know what they were a year ago and the numbers were higher. Those are going to roll off and you're going to start seeing the inflation numbers come down. The reason the interest rates have moved up is all this speculation about what policy might or might not do. So what you see in this box, and why I think fixed income is appealing, is your yield is pretty nice. You're clipping a nice 4.5% to 5% coupon right now. And what that means is that in environments where interest rates do move up, your value goes down, but at least you can absorb 4+% of that move by the coupon you're getting paid every month or quarter, right? You didn't have that a few years ago. The really bad bond experience we had a few years ago, when the Fed went from 0% to 5%, you just got straight movement up. Your bonds got hit and you didn't have any coupon. You didn't really have much coupon to absorb it. So it's a different environment than a few years ago. So you're good. You can absorb it. And I still think there's more reasons that interest rates will likely move down moving forward than move up. So hang on to your bonds. Again, it's the same message I had last year. We saw it at periods last year, but I just think the election and the discussion after it have kind of moved rates up, maybe overshot too much on interest rates moving up. We saw a pretty nice move down yesterday when the inflation numbers came in cooler. Let's see if that trend continues a little bit moving forward. So related to this is, I get the question all the time. It might have come through from you folks as well too. So what does this mean for my mortgage rate? Next question. Mortgage rates, I mean, do I think they'll come down? Yeah. I mean, I think they will follow as the 5 to 7 to 10 year kind of maturity part of what we call the yield curve of maturities comes down. Yeah, I think mortgages will fall, but they're not going back to where they were. I mean, I think 5.5 is the best you can kind of hope for, and I think they're going to take a while even to get there. Now, the period of upper 2s, 3% interest rates, I mean, we're past those, right? And that's because short-term interest rates were at 0. We don't want to go back to that world. So this is one of those be careful what you wish for. If you go, oh my gosh, I'd love the world again where I could get a 3% mortgage, or our kids, my kids are 24, 27, and 30. I have this conversation with them a lot. I am locked into a very low mortgage rate that I never want to give up. And they're going, well, when will I get that rate? And I'm going, well, you won't, because in order to get that rate, we need a crisis or a very deep recession in order to get short-term rates back down to zero. I'm not rooting for that. And I tell my kids not to root for that, because you know what happens in that world to my 3 kids who are out of the house and employed, and all of us are happy with that arrangement? It means 1 or 2 of them loses their job. So great, now you won't be able to get a mortgage anyways, because whatever crisis would have caused that to happen is going to cost you your job. So I think they'll drift down, but they're going to drift down to that 5.5 to 6% range. And I know that's not very satisfying to somebody 30 or younger. I still look at it and go, you know, my first mortgage was near 10. That sounds pretty good. When I talk to my 91-year-old father, who loves to remind me about his mortgage rates that are 15 and 16%, he thinks anything below 8, you're stealing it from whoever's lending it to you, right? So I understand it's all relative to your history in the markets, but it's hard to see them going back down much more than that. And the mortgage market's pretty tight, right? I mean, builders aren't going to oversupply after what they went through in 08. Quite frankly, 40% of America owns their home outright, so they're not really interested in the mortgage market. And most of the rest of us have a mortgage somewhere in the 3 to 4% range, and we're not crazy about selling or moving because we don't want to give up that mortgage. So it's a pretty tight market for supply. And that all kind of fits in too. But again, from the mortgage equation, maybe down to 5.5 or so if the Fed does what it says and takes its rate down to 3. But it's going to take longer to get there, because I think the Fed's on a slower path to get there now. So don't know. I probably more than you wanted to know on mortgages, but I think that's how that market probably will play out. The good side is I don't see too much of an environment to where they should move up much more. So you're kind of looking at maybe the worst case scenario, but that's not going to be very comforting if you are going, yeah, well, my payment's double what it would have been a few years ago, and that, yeah, that's just the reality of it. All right, let's move on to the next slide. Let's talk a little bit about. Let's actually just go to the next one, if you don't mind, Alex. Let's talk a little bit about policy, geopolitical. I kind of talked about this a little bit earlier. There's been 4 main issues since the election that have moved the market. And again, remember, we don't have clarity on any of these 4 issues. We just have talks and proposals, but we'll start getting more clarity. I think of 2 of them as being more market friendly, 2 of them not being as market friendly. And again, this is if implemented as discussed, right? So let's talk about the top 2. And I do link tariffs and immigration together, and you'll see why in a second. If implemented to the degree that they were campaigned on, yeah, I think it would bring more production back to the U.S., which, quite frankly, makes costs go up because it is cheaper to get goods outside of the U.S. We've been doing it for 30 years. I get the appeal of bringing things back home, but just recognize you're going to pay more for it because of our costs. But that's the assumption that drives interest rates up, right? And again, I think there'll be tariffs, but I don't think they'll be to the level being discussed. And because they're being discussed here, I think any relief on it probably brings rates down a little bit. The reason I tie immigration in there, and the administration knows this, the administration, I think, needs to be careful and think about these 2 policies together. What every politician in the developed world who ran for re-election learned last year, and by the way, 2 billion people in the world had elections last year. 50 plus countries had elections. And if you were in a developed market and you were an incumbent, chances are you lost. Why? Because inflation was everywhere, and inflation is the one area that people really don't like and will vote on it, okay? Administration knows that. And the reason I tie these 2 together is if you are going to bring more of it home, well, you need a labor supply in order to do that. And we've had nice, steady 150 to 250,000 jobs being added for years now. Over half of that labor supply has come via immigration. So if you are going to implement the immigration policy as it was discussed, and do I think there will be fewer people coming in? Yes. Do I think there'll be mass deportations? I'm skeptical on that. Do I think there'll be a higher emphasis on if you've committed like really bad crimes of finding those folks and getting them out. Yes, and I think that's the part that most people, that's what people want to see on the news, right? That's what they want to see. But if you do have higher tariffs and bring it home, you could lose a lot of your potential workforce that's being added every month, depending on your immigration policy. So I would anticipate those two both being softer than campaigned on and thought of together, because again, if I can figure this stuff out, I would imagine all the economists that are working under any administration are delivering the same news. Collectively, so far, though, when these hit the news, it's been kind of market negative. The other two have been more market positive, kind of equal sides of the equation here. Fiscal policy, I'll just say tax policy. Tax policy is gonna, I mean, the Tax Cuts and Jobs Act that were put into place in Trump's first administration. Yeah, I mean, I think they'll be extended. The corporate rate dropping, there's talks of trying to take the corporate tax rate from 21 to 15. I think that's going to be a harder one. I think there'll be enough Republicans in Congress that even with a straight sweep, it is a narrow margin. And I think there's enough Republicans that will push back and say, look, we can keep the tax cuts in place. And by the way, if you look at tax rates across a variety of taxes for the last 70 to 80 years, they're pretty low relative to history. So I think though some Republicans will say, but we can't lower them even more. We can't reduce the revenue source because the deficit's probably going to continue to grow no matter who's in office, right? I know there's an effort to take $2 trillion out. I think that's a political number, right? Because they're not going to touch Medicare. They're not going to touch Social Security. They're probably not going to touch defense, and they have to make the interest payments. There's not a lot left. You'd have to wipe out every other program in the country to hit 2 trillion. Do I think they'll make progress? Yes. Do I think there'll be headlines in the news that are positive on that? Sure. And that's, I think, what they're going for. But I think it's hard to maybe lower taxes further. So I'm assuming that taxes just kind of stay where they're at, which in and of itself, it would be market friendly. On any of these items, by the way, I'm not making a social judgment. I'm not saying which are good for the world or good for society. I'm just saying this is the way the market's going to react to them. And deregulation fits into that camp too. Do I think there'll be deregulation? Sure. It'll impact some industries more than others, financials, probably energy, healthcare, et cetera. It'll really impact small companies. Small companies are an interesting investment, maybe opportunity here because they're just trying to stay in business. So any expense that they have makes that harder. Deregulation goes away. That's an expense that goes down a little bit. They also benefit if interest rates drop, and I think interest rates will drop. Why do they benefit from that? Because they're borrowing money to survive every day, right? So these impact smaller companies more than larger companies. So deregulation, probably market friendly. Again, not saying it's good or bad. I'm just saying that's the way the market will react. So all four, and the areas on the right are just maybe ways that it'll show up in the numbers. I'm not going to go through each one of those. So these 4 items have been in the news. Again, depending on what's talked about, it's kind of moved the market back and forth. At least now we'll start hearing some real policy on all of these issues and be able to figure out, okay, so what does this mean moving forward from us? I used this slide a lot in November and December when people right after the election wanted to hear about these issues. It's starting to fade a little bit. People are getting maybe tired of hearing about all this. So, but it's still a topic I wanted to talk through because, I mean, politics are still obviously being talked about quite a bit. All right, I'm going to wrap up on the last slide, and then we're at about 30 minutes, which is about 20 minutes longer than, you probably want to hear from one person. So this kind of ties in with the opening one that I had about, so what do I do with all of this, right? Again, I'm kind of paralyzed maybe. Markets are expensive. I hear a lot of stuff on the news. I'm worried. I'm either happy with the election or I'm not happy with the election. So I think I'll just kind of, I'll just sit, paralysis, right? I don't want to do anything. So this looks at 5 different scenarios. So here's the underlying assumption. I'm going to give you $12,000 a year for 10 years. Okay. And the reason I use 12,000, it's 1,000 a month. You'll see in a second why I do that. And you're going to have ways to invest it or not invest it. Now, we've done this for 10 years. We've done this for 20. We've done this for 30. We've done it for different slices of periods. The data comes out to be just about the same. So this looks at the last 10 years. It just looks at the US market to keep the data easier and says, okay, so you got 5 different things that you can do. Number 2, 3, and 5 are actions you could actually do. 1 and 4 aren't, but I still think they're interesting to look at. So number 1. You're the best investor in the world. You should be doing this call every quarter because you know the market low, you hit it every single year, and you invest your $12,000. No surprise. After 10 years, you've turned your $120,000 into, 280,000 plus or whatnot. Okay. Scenario number 2, actually controllable. You just put it in on the first day of the year. You don't want to mess around with it. Market might be up, market might be down. Just put it in. Surprisingly, it does almost as well as the investor that's just brilliant. I'll talk about that in a second. Number 3, very common approach. I'm going to divide that 12,000 up into 12 months. I'm going to put $1,000 in the first day of every month. Market might be up, market might be down, commonly called dollar cost averaging, and I'm just going to put it in over time. You do just fine. Number 4, and the reason why I think this slide is so appealing and kind of resonates with a lot of us is a lot of us feel like box number 4 was built for us. You're the worst investor in the world. You seem to find the highest point every single year, the opposite of number 1, who finds the lowest point, and that's when you put your money to work, okay? Still did pretty well. And then there's the last box. You take my 12 grand every year, you stick it in a cash equivalent, cash, earning. Last year, maybe 5%, now maybe 3.5%, something in that range, all before taxes. But, well, then you basically get your 120,000 over time plus whatever that money market kind of earns you. So what's the observation that you see on the bottom? Again, I love a chart where you can just see it. It doesn't seem to really matter of the first 4. Yes, you do better if you're brilliant. 2 and 3, they're all kind of equal, and some people are surprised. And I think the reason why 2 and 3 are pretty close, and in fact, look at number 4. You could be a terrible investor, and you still did fine, because it doesn't matter your entry point. Time takes care of it, right? Markets go up 72% of the time. Longevity is what you're managing for. That money you were putting in was in the market so much of the last 10 years, it didn't really matter whether markets were up, down. I mean, sure, on the margin, you would have made more money in some cases, but all 4 of them are much different than scenario 5. Now, I'm not saying don't own cash. Everybody needs cash. We all have our own level of emergency fund. We all have our bills to pay. We all have our sleep at night factor. That's all built into your plan. That's a separate decision for me. But once we're talking about the assets to fund your longer-term longevity and retirement, that's where this other stuff comes into play. So between slide number 1 on how that 60-40 portfolio is done, slide number 2, which shows the different return buckets and how well the next year tends to do, and this one, hopefully, well, at least maybe give you a starting point to have in your conversations to say, okay, we do have this money. It's been sitting here for a while. We've always had an excuse. It's an election. It's the next Fed cycle. It's earnings cycle, whatever it might be. But we got to get this invested again, that you'll be more focused on the process to do it rather than we got to wait for the perfect moment and then we'll go in. There is no perfect moment. We never know that until it's already over. And quite frankly, we all miss the perfect moments because we're freaked out usually when the perfect moments are happening. So those are the 6 slides. Again, there's 20 more. I can spend another 2.5 hours and it's 6 slides on 30 minutes. So, there's your hit ratio. But they all tend to be related to these slides, and they're just different ways of saying the same thing. So what I want to do is send it back to you, open it up to see if there's any questions. I think I hit on the questions that I knew had already come in. I tried to weave that into my talk, but let's see where you want to go from here.
Yeah, so you're right, Mark. You pretty much cover most of the questions. I only have one that was not answered, or kind of like a feedback on what are your thoughts about geopolitics. So we talked about international in terms of how the U.S. economy is versus the world, but we didn't touch about geopolitics. These conflicts between China and Taiwan, Hamas, Israel, Russia, Ukraine. How do we see that maybe affecting the international
Yeah,
arena?
you always have them, right? I mean, the Middle East is not a new conversation. Russia's not a new conversation. China's not even a new conversation. And quite frankly, for the rest of our lives on every level, it's conversation about us and China is going to go on, whether it's, consumer spending, defense related, Taiwan, all of that. So you've always got geopolitical in the background, commodities markets, because some of these, well, at least historically, the areas that you talk about tend to be areas for energy. And so the commodities market is always the first one to move back and forth. But you've always got them, right? So you can't say, well, I'm going to wait until this stuff cools off and then get more invested, right? You'll your whole life, it'll never cool off. There's always something going on, right? So you just have to manage it. So what tends to happen in any of these, whether or not the US is directly involved in it or not, is you tend to get a short-term reaction. Think about Russia invading Ukraine and all the attention in markets on it. Again, the commodities markets are often the first place that have a reaction. And then time goes on and markets just kind of move on to the next thing, right? I'm not minimizing any of these issues, particularly if they're in a country that you live in. Obviously, it's huge, but from a market perspective, it just kind of moves on, and eventually things tend to get resolved, and then you get a little bounce back on resolution days. But you basically just diversify, right? You own stocks, which do well in good times. Bonds tend to do a little bit better when people get defensive. Maybe it's worried about geopolitical. Again, you have a little bit of commodity likes, maybe exposure. You own some REITs, you own some infrastructure. You just try to diversify your portfolio as much as you can, so you're not counting on one scenario where, well, the world has to be perfect for my portfolio to work, or the world has to be a disaster for my portfolio to work. So we just kind of manage those as they come up in real time. I mean, some are maybe more market moving than others, and obviously we'll adjust portfolios, but we can't sit back and go, well, we know that there's going to be a turmoil at some point, so we'll just be really defensive in our investments because we know it's coming. Again, we got to manage towards longevity. So you diversify as much as you can, you analyze it as it comes, you make tweaks to the portfolio as necessary, but it's been this way ever since the beginning of, humankind on the planet, and you just manage towards it the best that you can.
All right, fair enough. I think you cover everything. So like always, thank you so much. These have been great. I'm living it with longevity. It's what we are managing for.
There you
I'm
go.
gonna steal that
It's a
from
hard
you.
problem to solve for, but it sure beats the alternative, right? So
That is correct.
let's
And
manage for
it's very
that.
true. It's very true. That's exactly what we're doing. So thank you, everyone. And Mark, we'll see you again in July if
I
you
hope so.
come and talk to us. So happy New Year to everyone, and see you around. Thank you.
All right. Be well, everybody.
Thanks.